Today, I want to talk about UK dividend growth stocks that can help us sleep well at night. But how do they make us sleep well at night? Well, they need to have a safe dividend. And for us, that means they need to have five key components. They need to have consistent earnings growth, consistent free cash flow growth. They need to have a solid balance sheet. They need to have reasonable payout ratios, typically below 70%, but that changes depending on the industry. And we also like to see that management has a commitment to growing a dividend. And usually you can find that with a dividend policy, particularly on European companies. Now, before we get into discussing the five companies that help us sleep well at night, let's talk about why investors like UK companies. And one of the reasons is that they offer 0% withholding tax. Now, that doesn't mean that you don't pay any tax at all. You still have to pay tax at a local level. But me as an Irish investor, I don't pay any withholding tax at source. So with all that said, let's jump in and talk about the five UK dividend growth stocks that can help us sleep well at night. See you on the inside. So first up on the list is British American Tobacco, ticker symbol BATS. And those who watched my video last week will know that this company has crept into one of my top 3 positions within my portfolio. They currently have a huge dividend yield of around 6.94%. And typically, that's not a yield that you would associate with a company that would help you sleep well at night in terms of dividend safety. So what makes us confident that the dividend is safe? Well, first of all, they have delivered around an 8% adjusted earnings per share growth over the last 10 years. To complement this, they have grown the dividend at 5% CAGR. I like to see that the dividend is not growing faster than earnings or even free cash flow. So what about free cash flow? If we look at finchat.io, we can see that from 2019 up to the last 12 months, free cash flow has grown at a CAGR of around 10.78%. So overall, we can be quite comfortable knowing that the dividend is backed by growing earnings and growing free cash flow. What we also like to see is that management are committed to the dividend. And you can see that they state this quite clearly here. They remain committed to continuing their 25-year track record of consistent dividend growth, rewarding our shareholders through all economic cycles. And that's quite important for a company like British American Tobacco, who go through many ups and downs. We can also see that over the next 5 years, they are on track to generate around 40 billion of free cash flow before dividends. Back in 2023, which is the last annual report I have, they paid roughly 5 billion in dividends. If we assume around a 1% growth rate, that will give them a 77% payout ratio compared to that 40 billion that they're generating in free cash flow. That is a little bit on the high side, but I'm not expecting a huge amount of growth of the dividend over the next 5 years. But again, I have a high starting yield of around 8%, and 1% every year is just fine for a company with that kind of starting yield. The second company on the list is Halma PLC, ticker symbol HLMA. Now, you probably haven't heard us speak about this company much before on the podcast, but they are a company that has been going since around 1894. So it has a very, very long track record of being successful. They operate in 3 main segments. They operate in safety, environmental and analysis, and also healthcare. What I like about this company is that it is built to be recession-proof. And what I mean by that is Halma is supported by regulations. Health and safety is one of the most regulated areas within businesses all over the world, and that means that it can be steady even during downturns. Historically, their business model is around buying smaller businesses to grow around 5% year on year. Now, the company have delivered that in most years, but of course, that comes with its own risks. And one of these is that the CEO, Andrew Williams, retired after 18 years. And his ability to acquire businesses, look at their companies, you can see how many they have, will be quite hard to replace. So it's hard to see how that one will go. However, if we go back and look historically at their returns, we can see that dividend growth in this dark green colour here has been supported by its earnings growth in this light green colour here. You can also see revenue growth is quite strong. It's been 11% over the last 5 years. They have a payout ratio of around 30% in terms of earnings and around 30% also from their free cash flow. So they have a long record of paying dividends. They've got quite a conservative payout ratio. They've got a relatively strong balance sheet, and they are also committed to a progressive dividend policy. All that makes them a company that you can hold knowing that their dividend is safe. The only caveat that I would have here is that the dividend yield is quite low. It's currently around 0.86%, which for me, who likes to invest for income, it is a little on the low side. However, in terms of dividend safety, these are right up there, and maybe they might suit your portfolio. One of my favourite UK companies at the moment is Greggs, ticker symbol GRG. If you have ever been to the UK, you must have went to Greggs. It's one of these shops that are low cost, that offer pastries that are fast, hot, delicious, and you can grab them on the go. Every time I go to the UK, I make sure to go and visit one of these shops. They are well known for offering an affordable range of products from pastries, sandwiches, and coffees. What I like about this company is how fast growing they are, and they stick to the markets they know. They typically stick within the UK. They have tried to move outside that, such as in Dublin and Ireland, but it never quite took off the same as it does in the UK. So they are growing their stores rapidly within the UK. And you can see that here. Back in 2013, they had roughly 1,671 stores. And fast forward to 2022, they have 2,328. And they are well on track to reach 3,000 stores by the end of this year. Looking at their metrics, you can see that the revenue has been growing quite well. Their earnings or profit before tax has been growing. Their diluted earnings per share has been growing quite well. Even their dividend. Now, you notice that in 2020, it does look like they cut the dividend, but what they did is that they paid double the amount in 2021 to make up for that. So technically, I don't count that as a dividend cut, even though on the records, it will look like it has cut the dividend. But if you look at this dividend chart, you can see that it looks quite well, and they have even paid out 1 or 2 special dividends along the way. The fourth company on the list is Spirax-Sarco Engineering PLC, ticker symbol SPX. Now, Spirax sit proudly on European DJI's Noble 30 Index alongside both Halma PLC and British American Tobacco. Spirax are split into 3 core businesses: Steam Thermal Solutions, STS, Electrical Thermal Solutions, ETS, and also the Watson-Marlow fluid technology. Now, I could geek out here and tell you how good thermal solutions are based on their intrinsic safety, but I leave that for my day job. For now, let's have a look at some of the reasons why they help us sleep well at night in terms of dividend safety. If you go to their investor pack, you can see that they give a compelling investment case. They typically outgrow industrial production by 2 times. They've got strong cash generation, and their earnings and dividends have both grown over time. And if you go down to this presentation, you can see that laid out pretty clear for you. You can see that it has consistently outperformed industrial production by at least 2 times since 2004. They've got some really strong cash generation, but most of all, look at that dividend growth. You can see that earnings per share has grown at 9% over the last 10 years. Dividend per share has outpaced that at 11%, but that includes special dividends paid out in 2010, 2012, and also 2014. So I expect dividends pretty much to grow in line with earnings into the future. But who can argue with a 56-year track record of dividend growth? If you'd like to know more about this dividend king, or at least a European dividend king, then you can check out our deep dive on them over at dividendtalk.eu. And last but not least is SHEL PLC, ticker symbol SHELL. Now, those that listen to our podcast will not be surprised to hear SHEL on this list. And I know you might say, but how are they on this list when they cut their dividend back in 2020? Well, since then, this has become one of the best share cannibals in the world right now. They are repurchasing around 6 to 8% of its shares annually at current oil and gas prices. That is crazy. On top of that, they also have got a renewed dividend policy, and you can see that they aim to grow their dividend at around 4% every year, with a target payout ratio of around 30 to 40% of its cash flow. So, in my opinion, the dividends are safe for being cut anytime soon in the near future. Shell is one of the biggest energy companies in the world right now. They are involved in both oil, natural gas, and even renewable energy solutions, even though they're starting to pare back on some of these renewables because, quite frankly, the returns is not the same as both oil and gas. In my opinion, since they have cut the dividend, they are a much, much stronger company and are in a better position than they have been in decades. So there you have it, 5 companies that we think have sleep well at night dividends. There are some other companies that we did miss off the list. I can think of companies such as the London Stock Exchange Group, for example, or even BAE Systems. But please let me know in the comments below what companies should be on this list, and also if you'd like to see future videos on UK investment trusts. And as always, if you like these type of videos, please hit the like button and subscribe because it really helps the channel.